you've ever been having difficulty carrying out multiple time frame analysis, or you have been making some irrational decisions when you're trading and you cannot come to a conclusion whether you're going to buy this currency pair or you're going to sell that currency pair, in this video I'm going to explain what multi-time frame analysis is, how you can carry out top-down analysis and multiple time frame analysis, and how you can carry out proper analysis to improve your trading decisions. My name is Philip and welcome to another amazing and educative video brought to you by Learnity, and we will be talking about multiple time frame analysis in this video. So basically we're going to be looking at how to carry out multiple time frame analysis, and I'm going to go through all the necessities you need to understand when carrying out multiple time frame analysis. Now before we dive into the main heart of this teaching, if you're just starting out in the foreign exchange market, we have a 5-day free forex training program for you. This 5-day free forex training program has been embedded with so many educative concepts, so many impactful insights that are going to guide you, especially as a beginner trader, as someone who's just coming into the foreign exchange industry. This 5-day free forex training program has been developed in a way that it will give you all you need, from the basics to understanding what the foreign exchange market is, and get you trading in no time. Alright, so if you're just starting out, you can use the link in the description below of this video, sign up, save yourself a spot, and do not miss out on this 5-day free forex training program. So when we talk about multiple time frame analysis, what actually comes to everyone's head, or what you should be thinking of, is the usage of multiple time frame when carrying out your analysis and not just sticking to one time frame. Now most beginner traders have always come to me asking what time frame is the best time frame to use in trading, and I'm going to answer that question in this video. Now there is no particular time frame that is best for trading, because you need to actually use multiple time frames to understand your buyers and understand where the market is coming from on the higher time frame and execute on the lower time frame. All right, now not saying that you cannot use one time frame to carry out analysis and execute on, but I'm saying it is better for you to use multiple time frame, because that increases your chances of getting a larger risk to reward ratio, and we are going to see how that works in a few minutes. So on this pair, which is the USD Japanese yen, we are going to try to carry out a top-down analysis and come to a conclusion if you are going to buy or sell. Now the problem with using one particular time frame when carrying out your analysis is this: you might find it difficult coming to a conclusion if you are going to be buying or selling, especially if price is currently trading on a particular candle and has not closed yet. And that is why it is always recommended by top traders and experts to always use multiple time frames to get yourself to understand what is happening in the market, how the market is flowing, and actually where to execute from. Now another thing about just trading with just one time frame is that you might not have that precision you're looking for when it comes to executing. Alright, so if you're using just one time frame, a higher time frame or a lower time frame, depending on whichever you use. Now if you're someone who is using a higher time frame in carrying out your analysis and also executing, you're not going to get a precision when you're executing. And if you're someone who uses 5 minutes or 15 minutes or 1 minute charts when analyzing and actually executing, you might be lured into the price action on the lower time frame and do not have an understanding about where market is likely to go to on a higher or broader perspective, and that might be quite misleading, and you do not want to get caught up in all of the misleading price action on the lower time frame. So quickly I'm going to minimize this bar here, and we are going to carry out top-down analysis. Now personally, when carrying out my top-down analysis, I prefer to start from the weekly time frame, but in this video, because of all other type of traders, we might have swing traders watching this video, and I would like to start with the monthly time frame. Now what I do on the monthly time frame, or the first time frame, which is my weekly time frame if I was trading on my chart, is I want to understand where price has traded to and where it is coming from and where it is likely to go to next on that first time frame, which is my weekly time frame or my monthly time frame. Now the thing here is the weekly time frame is enough for you to start your analysis from, but if you're somewhat of a swing trader, you would usually want to start from the monthly time frame, because you'll be taking your executions on the 4-hour or even on the daily time frame. All right, so basically when you start from the monthly time frame or the weekly time frame, all you are simply looking at is where the market is coming from and where it is going to to understand the broader perspective of that particular asset or that currency pair you want to trade. All right, so on the monthly time frame here, we can see that we have just bearish candles closing on each of these candles. All right, so actually we now know that since January, February, March, and going into April, that price has actually been dropping. So generally we would want to be looking for lower prices because we have seen price actually dropping, and we also see a rejection from this level over here. All right, we can see how price came close into this level. We have an old high here, which is an important level. Price went above the high and dropped lower. Price retraces, and now price is dropping lower. So on a broader perspective on the monthly time frame, we can see that price is running for these lows here. But it is not just enough to know that or come to a conclusion because price is running to this low here. We should start taking a trade from here. We want to, refine and see where we are likely to trade from. And because we have, other type of traders, we cannot just execute using the monthly time frame. This is where we now drop down into a much lower time frame and look at how we can actually take the advantage of price moving down to this level here. So if you go onto the weekly time frame, we can see that we have some quite of bearish pattern and bearish price action. And one thing we can see is we have some level of resistance and support over here. So we can see this right here, which is a previous low on the weekly time frame that was broken and has been retested multiple times, and we are seeing a rejection off of that area. Now this might not be clear on the weekly time frame, and that is where you might want to drop down into the daily time frame to have a clearer picture. And as you can see here, this is more clearer on the daily time frame than on the weekly time frame, and that is one of the essential benefits of using multiple time frames, all right, when carrying out your analysis, because what you might not necessarily understand on one time frame might become more clearer going down into another time frame. So right here you can see this clear support over here. We have a reaction from this level over here. Price went up, dropped down, broke below it, and has retested this multiple times. All right, so this is now understanding or giving us the understanding that price is eventually bearish, and we want to trade in the direction of this pattern. So now what are we looking for? We have dropped off from the monthly time frame into the weekly time frame, and they are telling us the same story. All right, that price is actually bearish, and we should be looking for sells in a bearish market and not for buys in a bearish market. All right, so because we have that understanding from the higher time frames, which are the monthly, weekly, and daily, that price action is bearish, we can now want to take our entries on the 4-hour, 1-hour, or 30 minutes by refining them. All right, so what or how can we take our entries on the 4-hour, 1-hour, or 30 minutes? Now once we drop into that level, we would be looking for a retracement into an old area of what support or broken that could potentially act as resistance. Now remember, this is a higher time frame, support broken, turn resistance, and for us to take our entry, we can now refine that by looking for a lower level of support that would potentially act as resistance, or broken support that could potentially act as resistance. And if you look at this area here, we have a couple of them. We have this level over here, and I'll just change that to white. So we have this level over here, and we also have this level over here, which is a kind of some bit of consolidation before price dropped lower. All right, so we have this level here, which are the lower time frame levels we'll be looking for price to retrace into to take our entries. Now there are other multiple ways we can use. If we want to refine this furthermore, we can actually use our Fibonacci tool, the Fib retracement level. We put that over here or right here, and we extend that to this high. We can see that this current trading range is from this high to this low over here. Now if we want to take an entry and we want to have multiple confluence, we can wait for price to retrace above the 50% retracement level before we take our entries, and you can see where the 50% is over here. All right, so we can now say, instead of using this old area of support broken that could potentially act as resistance, we now want to use the confluence of our Fibonacci retracement level, which is sticking to any area of broken support that could potentially act as resistance, above the 50% area, and we have this over here. So this would be the level we'll be looking for our entry, and simply if price should retrace into this area here, we can set a sell limit order, putting our stop loss just above the swing high or this old area of a key level, which is a support broken turn resistance, and would be aiming for first this low over here. And then we can also use our Fibonacci extension levels for future targets. Now remember, we do not need to trade all the way down to this monthly higher time frame level we are looking at to make profits. All we need to look for is other areas that we can take profits on. We can see this old low here, which is another area of support that price might potentially react from, so we can actually take off some more profits here, or we can simply stick to using the Fibonacci extension levels for our profit taking purposes. As you can see, we have this 1.6 over here. This could be another take profit level for you, and this could also be another take profit level for you, depending on how you want to actually play the risks to reward. All right, so this essentially has covered everything you need to understand about multiple time frame analysis, or what we call top-down analysis, starting from a higher time frame and then refining all the way down into the lower time frame to have a precise entry and to have a precise execution. So you can see how we came from the monthly time frame by understanding the bias on a higher time frame and what market is doing, and then we now refined by going into the 4-hour and making our entry very little, because if you're on the monthly or the weekly time frame, I mean, how do you enter from the monthly time frame without using a very large stop loss just on this monthly time frame? So this basically covers everything you need to understand about multiple time frame analysis. So if you'd like to know how to blend multiple time frame analysis with your style of trading, whether you are a swing trader, whether you are a day trader, or whether you are a scalper, you can actually use different multiple time frame analysis in carrying out your top-down analysis. All right, so if you want to understand how we carry out these things, then I suggest you use the link in the description below. Head on to the Learnity's homepage, go to the course section, and get the Forex Foundation course or get the Advanced Forex Trading course. These courses have the multiple time frame analysis section in them, where we talk about how to use multiple time frame as a day trader, how to use multiple time frame as a swing trader, and how to use multiple time frame as a scalper. So when you get this course, you understand totally how you can actually blend multiple time frames with whatever trading style that you use. All right, so use the link in the description below, head on to the Learnity homepage and get the course right now. And this brings me to the end of this video, and make sure you're subscribed, make sure you like this video. If it has been impactful to you, give us a thumbs up, and make sure you click on that bell notification icon so you get updated on the next video, which is going to be posted on this platform. And until I come your way again next time, do well to trade well and trade safe.
Learn and earn with Learnity. Ready to boost your knowledge and get rewarded? With Learnity, every minute you spend learning turns into real rewards. Here's how it works. 1. Sign up or log in to your account. 2. Head over to the Rewards tab in your personal learning area. 3. Watch our free video tutorials and earn Learnity tokens for every minute you spend learning. The more you watch, the more tokens you collect, and those tokens can be redeemed for amazing rewards like gift vouchers, trading bonuses, cash rewards, and more. Don't miss out. Start your learning journey with Learnity today and make every lesson count.